Hello and welcome. Good morning, viewers, students, members who are all watching this telecast. On behalf of Vijayawada branch of SARC of ICI, the Managing Committee of the branch welcome you all to this 15-day course on income tax. This being arranged as a crash course will be useful especially for IPCC and final students. You are all well aware that the examinations of CA have been postponed for the second time and they are now scheduled at the July last. So the Managing Committee of Vijayawada branch thought it fit that some virtual classes for students may be conducted. Many of the students, you are well aware that previously we conducted a 15-day crash course on GST. At that time, we received many requests that a course on income tax also be conducted. Having regard to the requests made by the students, the Managing Committee of Vijayawada branch of SARC of ICI thought it fit that a 15-day crash course for IPCC and final be conducted for students. This will also be useful to members and also the accountants in carrying out their day-to-day duties. Now we have with us faculty Chundur Sudhir, who was also the faculty for GST crash course. Now I thank on behalf of Managing Committee of Vijayawada branch Chundur Sudhir, who has readily accepted to be as a faculty for this 15-day crash course. In this course, we will be covering various topics on income tax that are useful for the IPCC and final students, be it the basic concepts or deemed income concepts, heads of incomes, as well as chapter 6A deduction, assessment procedures, assessment of companies and other type of persons under the Income Tax Act, TDS, NRI taxation, double taxation avoidance agreements, international taxation, etc. I request all of you to subscribe to the YouTube channel of Vijayawada branch and also forward in your Telegram and WhatsApp groups about this course to your friends so that it will be useful to the students fraternity at large. I thank you for joining us and may I now request Chundur Sudhir to carry on the class. Thank you.
Good morning to all the viewers. So now we are going to begin with revision classes on income tax. So we have planned a direct tax crash course for 15 days. So covering from basics onwards till international taxation. We are going to plan each and every session so that students, members, all were going to get benefited by this knowledge session. And now we are going to begin our discussion. Sir, beginning with day 1. In day 1 we are going to deal with various aspects of direct taxation, basic concepts, and practically very important session, section 68 to 69D, unexplained cash credits. Those are all we are going to discuss in today's session. And along with that, residential status and its incidence of tax, not only deciding the status and later for resident and ordinary resident, resident but not ordinary resident, and non-resident, what are the different types of levy to be made, those are all we are going to discuss in today's session. and very important aspect practically regarding income deemed to be accrued or erased in India. Many might be aware regarding income accrued in India, but here we are going to deal with income deemed to be accrued or erased in India, which is a very important practical aspect towards examination purpose and for also members in practice. So now we are going to begin the today's session. So we have planned a 15 days crash course regarding this income tax covering various aspects. So now let us begin with day 1. We are going to begin with the basic concepts. So coming to the basic concepts, first we need to learn the components of income tax law. So since this being a crash course, so rather than discussing from example point of view, what we are going to do is we are going to mention the provision initially and later clarify the provision immediately. We are going to discuss provision and then the clarification which was required for practical purpose and also for examination purpose. So let us continue with our discussion. Now beginning with the components of income tax law. First of all, why we are liable to pay income tax to the government of India is the first question. For that purpose, so let me clarify you one thing, that our Constitution of India consists of articles. Like that we are going to have sections in each act. Here we are going to have articles in the Constitution, in which article number 246 in schedule number 7 consists of 3 lists: list 1, list 2 and list 3. So list 1 is the union list, where exclusive central government have right to collect the taxes. List 2 is the state list, where exclusive state government has right to collect the taxes. And list 3 is the concurrent list, where either central government or state government, both does not take the right. Either central government or state government is going to take the right to collect the taxes. Like this we have 3 lists which were specified in schedule 7. Out of this list 1, entry number 82 deals with income tax. So why we are liable to pay income tax to the government of India is, since the Constitution of India, article number 246, schedule number 7, list 1, entry number 82 has clearly specified that we are liable to pay income tax to the Constitution, to the government of India. And now on what item we need to pay income tax? For this purpose of entry number 82, government has constituted income tax law. Sir, what is the difference between Income Tax Act and Income Tax Law? Income Tax Act deals with specific provisions, rather than Income Tax Law forms the basis. Practically also we speak direct tax law, not only Income Tax Act. What is the difference between Income Tax Law and Income Tax Act? Here I have given you the presentation. Sir, law includes act. The components of income tax law, if you refer here, the components of income tax law, it consists of 5 components. Income tax law includes Income Tax Act. That means practically we should not only follow Income Tax Act also, not only Income Tax Act, we need to follow all the components of income tax law. Sir, what are the components that are covered in income tax law? If you refer here, number 1, Income Tax Act 1961, which consists of 298 sections and 14 schedules. And coming to second point, income tax rules also forms part of law. Sir, Income Tax Act, wherever the term that was specified as prescribed, whenever in act the term as prescribed has been mentioned there, it is being clear convention that you have to refer the rules. In practically also, section 10 subsection 1 of Income Tax Act specifies that agricultural income earned in India is exempted. But it does not specify when there is a composite income. For suppose SSC is in the business of growing and manufacturing tea. Growing is part of agriculture, whereas manufacturing of tea is part of business activity. If SSC has this composite income, Income Tax Act has not specified the procedure for bifurcating this agricultural income and business income. Then what has specified this bifurcation is income tax rules rule number 7, 7A, 7B and 8 has clearly specified that whenever SSC has composite income, in case of growing and manufacturing tea, 60% agriculture income, 40% business income. Growing and manufacturing coffee, in such a case, what they have specified is 75% agriculture income, 25% business income. If roasting activity is also been done, 60% agriculture income, 40% is the business income. So like this, growing and manufacturing rubber, 65% agriculture income, 35% business income. Like this, what the government has done is, agriculture income has been exempted, is being specified in Income Tax Act. But coming to income tax rules, rules shall also be form part of income tax law. In our syllabus, both practically and for examination purpose, direct tax law forms part. That means income tax law we need to follow here. That law includes Income Tax Act number 1, income tax rules number 2, and coming to number 3, circulars and notifications also forms part. Sir, what is the difference between a circular and a notification? If they are going to introduce any amendment in the provisions of the law, generally on yearly basis, by way of introducing finance bill, the amendments in the provisions of the act will get applicable. But if a change requires during the middle of the year, the government brings the change in the law by way of issuing notifications. So this notification shall be issued by the central government, which is binding on all the people, not only SSCs, income tax authorities, department, all the people were required to comply with the notification. But coming to circular, circular is not the change in the provisions of the law. Circular means nothing but clarification in the provisions of the law. For better administration, in order to follow in a easy manner, everyone need to think in the same way. For the purpose of such interpretation, what they have specified is income tax circulars. Circulars are meant to clarify the provisions of the income tax law. For that purpose, the circulars will be introduced. Whether circulars are binding on the SSCs, generally circulars are binding on the department but not on the SSCs. But since it is a clarification, generally all the SSCs shall also follow such circular. So here coming to the difference between the circular and notification, notification is binding on all the persons, SSCs, department and every person, whereas coming to circulars, it is binding only on the department. But SSC generally follows the circular also, because circular is meant for clarifying the provisions of the act. Okay. So next, coming to judicial decisions, Supreme Court and High Court decisions. Sir, High Court decisions were binding over its jurisdiction also. Every state consists of their respective High Court. That High Court decisions were applicable within its jurisdiction only. For suppose, if Karnataka High Court has passed a judgment, whether that judgment is binding on the people in Andhra Pradesh, answer is no, because the High Court judgments were binding within its jurisdiction only. However, the facts of the case might be used by the SSC for the purpose of his interpretation. Facts shall be interpreted, but the judgment passed by other jurisdiction, other High Court. For example, if Karnataka High Court has passed the judgment, that judgment is not binding on the SSC who is living in Andhra Pradesh. Andhra Pradesh people need not follow the judgment passed by Karnataka High Court, because High Court decisions were binding only with respect to such a jurisdiction only. But coming to Supreme Court decision, it is binding on all over India. The Supreme Court decision needs to be complied by all the states irrespective of the jurisdiction, because the Supreme Court, which is only one court in India, their ruling is applicable, their judgment is applicable for all over India. And here we are also going to discuss the Supreme Court and High Court decisions in a manner. The topic when we discuss the relevant cases also, we are going to discuss here in a phased manner. So here is the judicial decisions. And coming to Finance Act. Sir, Finance Act, in 2019, Finance Act 1 and Finance Act 2, before elections and after elections, two Finance Acts were being passed by the government. Generally, government is going to draft a finance bill, and if it receives the approval from the parliament, and then Lok Sabha and Rajya Sabha approval, and it receives the assent of the President of India, then finance bill becomes Finance Act. that Finance Act is applicable, which is to be followed by all the SCs. That means every year government is going to release a budget whereby various changes in the Income Tax Act, GST Act has been specified in such Finance Act only. That Finance Act should also be forms part of our discussion. So Finance Act 2020, a recent Finance Act which is being passed. So some provisions regarding to such Finance Act 2020 also we are going to discuss here only. If we begin the discussion each topic so that everything will get clarified in a phased manner. So like this, these 5 points were part of income tax law. Income tax law consists of these 5 components. Law includes act. Not only act, rules, circulars, notifications, judicial decisions, Finance Act, everything here forms part of income tax law only. So that income tax law we are going to discuss from 15 days point of view, so that every provision might be focused in an easy manner. Now coming to definition of the term person. Sir, what do you mean by the term person? Person includes individual, that means whoever has earning capacity. Whoever has earning capacity, the government has classified them as persons. These are all the persons who have earning capacity in India. Individual, HUF, Hindu Undivided Family. Sir, Hindu Undivided Family, what they have specified that ancestral property incomes shall be taxable in the hands of HUF. Here the term that was defined is Hindu Undivided Family. Whether Income Tax Act shown any religion preference here, this is not the discussion. Income Tax Act does not have any religious preferences. Since in case of Hindu families, a Hindu Succession Act is available. For that purpose, what they have specified is Hindu undivided families shall be assessed as a separate persons. Here undivided families means undivided properties. The ancestral property income shall be taxable in the hands of HUF. Sir, what about Christian undivided families and Muslim undivided families? There also there might exist ancestral properties. Whether such ancestral properties out of other religions shall also be classified under HUF? Answer is no. Only in case of Hindus and Sikhs and Jain families also were being included in this Hindu undivided family only. Rather than these 3 religions, Muslims and Christians, if they have any ancestral property income, they shall not be taxed under HUF. They shall be assessed as an AOP or BOI, Association of Person or Body of Individuals. So they might be classified as AOP. As an association, we are going to tax them. Only in cases where Hindu Succession Act is applicable, only in that cases only what they have specified is HUF has to be assessed. And coming to number 3, Association of Persons, Body of Individuals. Sir, and partnership firm. What is the difference between a partnership firm and an association of persons? Partnership firm, if a deed exists in writing signed by all the partners, here registration is not the criteria. If a deed exists in writing which is signed by all the partners, then we are going to assess it as a partnership firm. If such deed does not exist in writing which is signed by all the partners, then we are going to assess it as association of persons. Sir, is there any difference in the assessment? Yes. In case of association of persons and partnership firm assessment, we have 3 differences between the assessment of AOP and partnership firm, which we are going to discuss in detail in day number 7. In day 7, what we have focused is assessment of partnership firms. Assessment of partnership firms, AOP and LLP. Here I am going to give a clear clarification regarding assessment of firms and LLP to you. And now coming back to our discussion, company, it may be a private company, public company, one person company, whatever may be. So all these persons shall be included in the definition of the term company. All forms of companies were liable to tax. And coming to cooperative societies. Sir, cooperative societies, it's whether it is a profit motive or non-profit motive is not the criteria. Cooperative society is a person. Even though most of the cooperative societies claim deduction under 80P, these deductions also we are going to discuss in one of the session. Deductions from 80C to 80U. In day 6 we are going to give a clarification regarding them. So exemption is the second thing. Initially we have to include them in the definition of the term person. and hence cooperative society is being considered here. And coming to point number 7, local authorities. Local authority means municipal authority, cantonment boards, whatever may be. It has been included in definition of the term local authorities, panchayat, whatever may be. Local authorities shall also have certain incomes, rental incomes, business incomes, deposit interests, like that any other income might exist in case of local authorities also. While coming to local authority, they have exemption under section 10 subsection 20. Local authorities can claim exemption under section 10 subsection 20, and hence what we are going to specify here is exemption is the second thing. First we are including them in the definition of the term person, and when we are going to deal that local authority means certain assessments we have considered here. Coming to this course, here we have certain assessments regarding trust, business trust, day 9. On that day only we are going to discuss assessment of local authorities also. And coming to artificial judicial persons, temples, trust, political parties. So these are also considered as artificial judicial persons. So whether they might claim exemption under section 11, whether they were registered under section 12AA is not the criteria. Initially we are including them in the definition of the term person, and later whether we are going to tax them or we are going to give exemption to them is the second thing, which shall be discussed in assessment of trust to you. So here we have completed definition of the term person, and coming to definition of the term SSE. What is the difference between the term person and SSE? Sir, all the SSEs are persons, but all the persons were not SSEs. When a person becomes an SSE means if they have the taxable income, when there might arise a chance to levy tax liability, then he shall be termed as an SSE. So SSE means who has paid any tax or penalty. Sir, what they have specified here is the term paid. If I do not pay any tax, am I not an SSE? Means, sir, even though you are not going to pay the taxes, if the tax liability arises, but you have not paid the taxes, then you shall be called as SSE in default. Such SSE in default is also included in the term SSE. So the term SSE not only includes the person who have paid the taxes or penalties, it also includes the persons who have not paid the taxes. Sir, what do you mean by the term SSE in default? Tax payable but not paid. Tax payable but not paid, or TDS payable, TDS or TCS payable but not paid. So what they have specified here is tax payable but not paid and TDS payable but not paid. So in such a case, that SSE shall be treated as SSE in default. Such SSE in default is also an SSE. And coming to next part, definition of the term deemed SSE. Sir, what is the difference between a SSE and deemed SSE? In certain cases, SSE might not be in a position to file the return or attend the scrutiny or income escaping proceedings. In such a case, assessment shall be done on behalf of the SSE in the name of the deemed SSE. For example, if you refer here, trustee of a trust is the deemed SSE. Here, trust is the SSE and trustee is the deemed SSE. And coming to deceased person, if a person has incurred his death and if any tax liability pertains regarding to him, then assessment shall be made in the name of the legal representative. So here deceased person is the SSE, legal representative is the deemed SSE. And coming to a non-resident, since a non-resident is located outside India, if any rental income or other business income arises in India, then who is going to pay the taxes on those incomes? In such case, this non-resident is liable to appoint an agent in India. Such agent shall be treated as the representative SSE, who is nothing but the deemed SSE. So now proceedings shall be initiated again as the agent. And coming to income of a minor. Sir, minor income shall be clubbed in the hands of the parent. Then what is the question of deemed SSE? If minor has his self-generated incomes, if he earns any income out of his own skill, talent, out of singing, out of dancing, out of acting in a film, if minor earns his own income out of his experience and skill, such income shall be accessible in the hands of minor only. But since minor does not have signing capacity, the legal guardian or manager shall be treated as the deemed assessee. And if any property is under the handover of the court, for suppose Mr. A and B, who were brothers, has a dispute on regarding a fixed deposit or land. Present, if there any income arises out of this disputed property, the court of wards, the place where this discussion is being carried on, court of wards is treated as the deemed assessee. The income arising out of this land or building shall also be deposited in a separate account, and such amount the tax liability arises in the hands of the court of wards is the conclusion. So like this, what they have specified is deemed assessee. In case where assessee cannot be taxed, government has introduced the provisions of deemed assessee. And continuing to our discussion, definition of the term previous year. Sir, difference between the previous year and assessment year. Generally, the incomes which were earned during the year 1920, in accounts we term it as financial year. This income calculation, how much we have earned income, what is the tax liability, this calculation shall be made in a assessment year. Next year we are going to make the calculation, and hence this is called as assessment year 2021. The term calculation is termed here as assessment. So here what they have specified here is financial year 1920 is called as assessment year 2021. So in Income Tax Act, in place of financial year, we are going to term it as a previous year. That means from accounts point of view, the term financial year, and from income tax point of view, the term previous year, for one and the same. Okay. So now coming to filing of our income tax returns. Now we are eligible to file the forms for the assessment year 2021, but still the government has not yet released filing forms. But now what we are going to do is, now we are in May 2020. So since March 31st 2020 has been completed, so here we are going to assess the income relating to previous year 1920 in assessment year 2021. So this is definition of the term previous year and definition of the term assessment year. Okay. Next, coming to charging section, very important provision of Income Tax Act. So section 4 is the charging section. What it has specified is tax shall be charged at the rates prescribed for the year in the relevant annual finance act. So tax rate shall be specified in annual finance act on that total income earned during the previous year. On the total income earned during the previous year, we are going to levy tax at the rates specified in the relevant finance act. So here we need to get clarification regarding what are the tax rate which was specified in the finance act. Those tax rates we are going to discuss. Okay, and then we shall come back to this provisions again. Now beginning with tax rates now. In case of individual, HUF, AOP, BOI and every artificial judicial person. So generally, sir, now I am going to specify you in assessment year 2021 terms basis. So Finance Act 2019 forms part of my discussion, but not Finance Act 2020. There they have specified with deductions, without deductions, two types of circumstances. Those we are not going to discuss, since next we are going to file returns for the assessment year 2021. Based on that session only, we are going to continue our discussion. So coming to assessment year 2021, what they are going to specify here is in case of individual, HUF, AOP, BOI, if the total income does not exceed 2,50,000, if the total income does not exceed 2,50,000, tax rate is nil. 2 lakh to 5 lakhs, tax rate is 5%. Sir, there is a rebate under section 87A. Okay, we shall discuss this in the next step. Here we have the concept of rebate. Before concluding to such rebate, first we need to learn the tax rates. Coming to 5 to 10 lakhs, the tax rate is first 5 lakhs 12,500, and next coming on balance 20% in excess of 5 lakhs. And if the income is greater than 10 lakhs, first 10 lakhs 1,12,500, and in excess of them we are going to levy tax at the rate 30% is the discussion. So here coming to point number A, generally But if SSE is of age 60 or more, even though the exact age is 60, sir, this 60 has to be considered as on 31st March 2020. By this date of filing return is not the criteria. By the end of the previous year, if SSE attains the age of 60 or more, then up to 3 lakhs the tax rate is nil, and remaining all the provisions were one and the same. And coming to the person with age 80 years or more who becomes a super senior citizen by the end of the previous year, in such a case, what they have specified here is up to 5 lakhs the tax rate as nil. Okay, and remaining all the provisions 20% and 30% were one and the same. And now coming to the very important discussion, this is useful to the persons whose birthday is on 1st April 2020. Whoever attains the if the SSE's birthday is on 1st April 2020, on this 1st April he is going to attain 60 years. This means that he has completed his age of 60 years by 31st March 2020 only. By 31st March 2020 itself, SSE has completed the age of 60 years. And on this 1st April, if SSE is going to celebrate his 60th birthday, he can claim senior citizen benefit for assessment year 2021 only. Sir, this special case is useful to the people whose birthday is on 1st April. If on 1st April itself he turns into the age of 60 or turns into the age of 80, in such a case, on 31st March itself he has completed his 60 and 80 years, and they are eligible for higher exemption limit of 3 lakhs and 5 lakhs is the conclusion, which is useful for SSEs whose birthday is on 1st April. Okay. And next, coming to the cooperative society, sir, most of the cooperative societies shall claim deduction under ATP, which is a second thing. But generally the tax rate, this ATP we are going to discuss in one of the day in deductions chapter. Before going into the discussion, generally what is the tax rate that was being levied in case of cooperative societies? Sir, in case of cooperative societies, where the total income does not exceed 10,000, 10%. So 10,000 to 20,000, first 10,000 1,000 rupees, and in excess of 10,000, 20% has been specified here. And if the exceeds 20,000, if the total income exceeds 20,000, 3,000 rupees on first 20,000, and in excess amount 30% of tax is being levied in this case. This is with respect to cooperative societies. And coming to firms and LLPs, what they have specified here is tax at the rate 30% has been specified. So there is no basic exemption limit in case of firms and LLPs. A straight away tax rate at the rate 30% has been specified in this case. And coming to fourth point, in case of assessment of a local authority has certain incomes which were exempt under 1020, which we are going to discuss in later point of view. But here the local authority is accessible to a tax rate at the rate 30% is being specified. And coming to the definition of the term company tax rates, so very important change has been incurred in Finance Act 1 and Finance Act 2 also. In case of companies, I have divided it into two categories, domestic company and foreign company. Coming to domestic companies generally have tax rate at the rate 30% generally. But what they have specified is in the previous year 17-18, if the turnover does not exceed 400 crores. So let me clarify this provision. In previous year 17-18, if the turnover does not exceed 400 crores, then in previous year 19-20, you are going to pay tax at the rate 25%. So the tax rate for the previous year 19-20 does not depend on 18-19. It depends on previous year 17-18. If in previous year 17-18, if the turnover does not exceed 400 crores, then during the previous year 19-20, here they are going to levy tax at the rate 25% has been specified in this case. Okay. So this was regarding companies, general tax rate 30 and 25. But in these two cases, companies were liable to compute book profit also On total income, generally we are going to levy tax at the rate 30% and 25% on total income. But here what they have specified is on total income, along with total income, here we need to compute book profit also. On that book profit, a tax shall be levied MAT at the rate 15%. Earlier MAT rate is 18.5%, but with effect from assessment year 2021, MAT rate has been reduced to 15% of the book profit. So in case of companies, sir, we have a separate discussion on assessment of companies, where we are going to discuss in detail in day 8 regarding assessment of companies. But before continuation of such discussion, here what we are going to specify is, in case of companies, they need to calculate two types of incomes. Number one, total income, and number two, they also need to compute book profit. And among these two, the higher tax shall be paid. In these two cases, book profit shall also be applicable, where MAT at the rate 15%. Sir, whether the company is liable to pay normal tax or MAT, the conclusion that was given here is whichever is higher tax should be paid. If MAT is higher, MAT credit can be claimed. That discussion we are going to make it in a detailed manner in day 8. Before continue for discussion, practically and for examination purpose, very important discussion regarding 22% and 15%. Section 115 BAA and BAB has been introduced practically. So where they have specified here is, in case of 22 and 15%, the company were required to, MAT stands for minimum alternate tax, and here there is no MAT in case of companies who opt tax at the rate 22% and 15%. If you opt 30 and 25, you need to calculate MAT also. But if you come for 22% and 15%, you need not compute MAT. It's very beneficial provision. Rather than coming to 30 and 25%, it would be beneficial to the companies to opt 22 and 15%, because here the tax rate is very lower comparing to 30 and 25%. It would be beneficial to the companies to opt this 22 and 15%. Sir, when 22% and when 15%? Here I have given you a clarification. BAB section deals with tax at the rate 15%, whereas BAA deals with tax at the rate 22%. So what they have given clarification here is, this 15% is applicable only for manufacturing companies. Only for the manufacturing companies, here tax at the rate 15% has been specified. And coming to other companies, trading companies or any other person, what they have specified here is any domestic company shall follow tax at the rate 22%, trading company or manufacturing company. Generally, in case of manufacturing, it would be beneficial to opt this 15%. Other than manufacturing, if other income exists, other sources or house property, on that income, tax at the rate 22% has been specified in section 115 BAA. Sir, what if a company does both manufacturing activity and trading activity? For this purpose, the company is required to bifurcate its profits regarding manufacturing activity and trading activity. So here, income other than from manufacturing, 22% shall be levied. Here tax at the rate 15% has been specified only on the income from manufacturing activities only. Okay. Sir, before continuing my discussion, so I would like to suggest to all the viewers to watch the video at a configuration of 360. So in order to get the screen visibility in a easy manner, if you need to see the screen clearly, you need to watch the video at least in 360, so that the screen would be very easily visible to you. Okay, right. Next, coming to our discussion, here in case of manufacturing activity, tax at the rate 15% has been specified. If a company has income other than from manufacturing activities, there what they have specified is tax at the rate 22% only. This 15% is only on manufacturing activity profit only. But along with this 15%, surcharge at the rate 10% and health and education cess at the rate 4% is mandatory. Generally, surcharge shall be levied only when the income exceeds 1 crore. But if the company opts tax rate at the rate 15 and 22%. Here a mandatory surcharge has been specified at the rate 10% and 10%. Here 22%. So what about capital gains? Long-term capital gain under section 112, 20%. 112A, listed securities if are being sold, a special tax rate at the rate 10% has been introduced. And short-term capital gain under section 311A, generally on short-term capital gains, normal levy shall be levied. But in case of listed equity shares, if were sold on which STT has been paid, 15% short-term capital gain tax rate has been specified. So here the special tax rate in 112 we have special tax rate of 20%, here we have 10%, and here we have 15%. These special rates were common as they have been discussed in those sections. Even though the company opts tax at the rate 15 and 22% also, these special tax rates were common only. That means if a manufacturing company opts tax at the rate 15%, has any income taxable under the head capital gains, the tax rate which was specified in long-term capital gain at the rate 20% is only applicable. So what they have specified is on the capital gains, those special rates, this 20, 10, 15% shall only be levied. Rather than that capital gains, if any other income exists, in case of domestic companies, 15% has been specified, manufacturing companies, and any other domestic company tax at the rate 22% has been specified. So short-term capital gain other than 311A, only on listed securities short-term capital gain only 15% tax has been specified. If I am going to sell a land, if a land is being sold on which short-term capital gain arises, what is the tax rate? Normal slab rates only. So based on that, here there is no part of slab rates here on any other short-term capital gain other than 311A. On 311A we are going to levy 15%. On any other short-term capital gain other than 311A, here tax at the rate 22% is only specified. Okay, but in order to follow this 15% tax rate in case of manufacturing companies, they have imposed certain conditions here, and those conditions were it should be set up and registered on or after 1/10/2019. Here the entity must be set up on or after 1/10/2019 because this amendment has been introduced in Finance Act 2, for which they have specified that it has to be set up on or after 1/10/2019, and it must start its manufacturing activity by 2023, and it must purchase a new plant and machinery only. Second-hand plant and machinery is ineligible. But there are certain exceptions. What they have specified here is, if the second-hand plant and machinery is imported plant and machinery, it is eligible, or any other second-hand plant and machinery, it should not exceed 20% of the total value of the plant and machinery. So what they have specified here is, any other plant and machinery should not exceed 20% of the total value of the machinery is being specified in this case. Okay, so this is very, very important. Generally, in case of companies, tax at the rate 30 or 25% has been specified. Tax at the rate 30 or 25% has been specified. But now we have categorized them into 15 and 22%. So since here the tax rate has been reduced, the government is specifying that these deductions were not available to the SSE. If a company opts 15 and 22%, the benefit available is no MAT. We need not compute book profit and MAT in case of companies if they opt 15 and 22%. But here what they have specified is no deduction under section 10AA. Here various deductions available under Income Tax Act must be foregone by the companies. These deductions must be lost. If those deductions were lost, then only company can claim a tax at the rate 15 and 22%. So what are the deductions the company is required to lose? 10AA, sedge exemption. In case of sedge, export profits were eligible for deduction for 15 assessment years. So this 10AA exemption cannot be claimed is the first one. And next coming to second one, section 32(1) subsection 2A. This is regarding additional depreciation. Generally, if a new plant and machinery is purchased, 20% of the plant and machinery cost can be claimed as deduction In case of manufacturing sector, that additional depreciation must be foregone. 32 AD, investment allowance. In case of a factory which was located in notified backward areas of Andhra Pradesh, Telangana, West Bengal and Bihar. These 4 states, there were certain notified backward regions, and those region names we are going to discuss in the chapter PGBP, Profits and Gains from Business or Profession, in a detailed manner in day 3. So now coming back to our discussion, that investment allowance 15% of deduction is eligible, and that deduction should be foregone. That 15% deduction cannot be claimed. 33 AB, tea, coffee and rubber development account. The SSEs who were engaged in the business of growing and manufacturing tea, a deduction at the rate 40% of the profits is available. Thus deduction should be foregone by the company. If that deduction is foregone, then you can opt this 15 and 22%. And coming to next, 33 ABA, site restoration fund. SSEs who are in the business of extraction of mineral oils, so that SSEs can claim 20% of the profits as deduction under section 33 ABA. That deduction should be foregone. And coming to section 35, scientific research, eligible projects, specified business 35 AD, all those deductions, in-house research, rural development programs contribution, agriculture extension project contributions, here we can claim 150% of the donation given as deduction, and those deductions should be foregone by the SSE to claim this 15 and 22% tax rate. And very important, IA to RRB, which for profit linked deductions, we are going to discuss this deduction chapter in our discussion in day number 6 in a detailed manner. Those profit linked deductions should be ineligible to the companies. So if they are going to not claim those deductions 80 IA to RRB, then only the company is eligible to opt tax at the rate 15 or 22%. And this is very, very important. Earlier losses also cannot be carry forwarded. Generally, if a loss is incurred in the current year, we shall carry forward it to the next year. But here, no loss can be carry forwarded. Entire loss is ineligible for carry forwarded to the next assessment year is being specified here. And coming to here, no additional depreciation. Additional depreciation cannot be claimed. Generally on plant and machinery, here I have specified you 20% we can claim, that is not eligible. Even brought forward MAT credit. Sir, this is eligible for existing companies also. This in case of new companies which were incorporated after 1/10/2019. And coming to the second part, this is eligible for existing companies also. If in assessment year the company has opted in 1920 tax at the rate 30 or 25%, now in assessment year 2021 this company can opt this 22% tax rate. This 22% is available for new companies also, new companies and existing companies, whereas this tax at the rate 15% is available only for new companies. So this is the provision here. And in case of existing companies, if you have any MAT credit, that MAT credit also cannot be set off. You have to waive such MAT credit here. So this is the condition which was imposed in this 10th point. And if you lose these deductions, then you are eligible for 15 and 22% is the conclusion given here. So it is the sad thing to be discussed here that these deductions should be foregone. Sir, these deductions as of now we have not claimed to any of our clients. In such a case, this is a very beneficial provision to you. Now you shall pay tax at the rate 15 and 22% only. If you are going to claim if you want these deductions, you should not opt this 15 and 22. Sir, whether in further years we can change this discussion. For example, now we have opted tax at the rate 15%. Okay. Next year we need to claim deductions, whether we can get back to 30%. No. Sir, coming from 30 or 25% to 15 or 22% is eligible. But what they have specified here is 30 or 25% to 15 or 22%. Yes, they are eligible. But if you now opt 22 or 15%, later can I change to 30 or 25%? Answer is no. So change from 30 or 25 to 15 or 22 is always eligible. But from 22 or 15 to 30 or 25, you are ineligible to convert from lower to higher. But you can convert from higher to lower is the conclusion. Okay. So this was regarding this provision. So by this we have completed tax rates relating to various assessees. And now coming to the concept of surcharge. So coming to the surcharge, when assessees were liable to pay surcharge on the income tax. Generally, surcharge is levied on the tax. First we need to calculate tax based on above my discussion. First you need to calculate tax amount, and after computing the tax, now we need to add surcharge. How much surcharge we need to add is the discussion that was arising in this case. So in case of individual HUF, AOP, BOI, they have specified certain slab rates to add for surcharge. Sir, first we need to compute income tax. After computing income tax, here we need to add surcharge. After computing income tax, here we need to add surcharge. So surcharge, how much we need to add on this income tax? After adding surcharge, then we need to add health and education cess. So how much is the surcharge to be included here is the question that was arising. So here a slab rates has been specified. Below 50 lakhs, if individual has income, total income below 50 lakhs, then there is no concept of surcharge. But if the total income is between 50 lakhs to 1 crore, a surcharge at the rate 10% has been specified. Okay. And if the income is between 1 crore to 2 crores, then surcharge at the rate 15% has been specified. And when the income is between 2 to 5 crores, surcharge at the rate 25% has been specified. And when the income is greater than 5 crores, surcharge at the rate 37% has been specified. Sir, what about this 15% and this 15%? So let me conclude it in an easy manner. So in case of individual, HUF, AOP, BOI and AJP. Now this provision of surcharge will be very clear to you. I am going to categorize them into 3 parts here. First, general. Total income less than 50 lakhs, surcharge 0. 50 lakhs to 1 crore, surcharge that was specified here is 10%. 1 crore to 2 crore total income, surcharge that was specified here, if you refer, first 10% and next 15%, it was increased to 15%. Coming to 2 to 5 crores, surcharge at the rate 25%. Greater than 5 crores, surcharge at the rate 37%. This surcharge is levied on the normal tax payable by the assessee. And now coming to our discussion, now we are going to consider general plus capital gains. If any capital gains exist, long term capital gain which was taxable under section 112A on listed securities, what they have specified here is on listed securities 112A in excess of 1 lakh, a special tax rate at the rate 10% has been specified in case of listed equity shares which were being sold on which STT has been paid. They have specified a special tax rate on 10% in excess of 1 lakh. If a long term capital gain 112A is 5 lakhs, first 1 lakh is exempted. In excess of above 1 lakh we have 4 lakhs. On that 4 lakhs, special tax at the rate 10%. Then how much is the surcharge we need to add in such case? Okay. Now in this case, if this general income plus capital gains also exist, on capital gains also surcharge nil. On capital gain tax also surcharge 10%. Here on capital gain tax also surcharge 15%. But here generally capital gain tax rate under 112A itself is 10% and 111A itself is 15%. How can government levy surcharge in excess of the normal tax rate? For such purpose, in this case, on capital gain income we need to levy 15%, and on other incomes we need to levy surcharge at the rate 15%. So coming to this 37% also, on capital gains tax surcharge at the rate 15%, on other income taxes surcharge at the rate 37%. Once again I am going to give you a conclusion that this surcharge is applicable on the tax payable by the SSE. First we need to determine the income tax. On such tax payable, here surcharge how much we need to levy is the conclusion that was given. These two are the special cases. Even though here surcharge is 25 and 37%, here surcharge has been restricted to 15% only, because here tax rates itself were 10 and 15%. How the government can levy a surcharge in excess of the tax rate, and hence the surcharge has been given as the rebate. Okay. And next coming to third part, here we are going to discuss one special case. By this we can conclude the concept of surcharge. Here is the special case, point number 5. If short term capital gain 40 lakhs, long term capital gain 112A is 55 lakhs, other income 1.3 crores. That means if you add these three items, now the income has exceeded 2 crores. But since the capital gains were included, the income has exceeded 2 crores. If we are not going to include capital gains, then the income is less than 2 crores only. Generally, when the income exceeds 2 crores, surcharge at the rate 25%. But excluding the capital gains, if the income does not exceed 2 crores, then on this tax, surcharge at the rate 15% is only levied. Let me give an example so that it might be easily understood by all of us. So here, short term capital gain 40, long term capital gain 55 lakhs, other income 1.3. So total 2.25 crores. Out of this 2.25 crores, tax on 40 lakhs at the rate 15% plus surcharge at the rate 15% only. Tax on 55 lakhs long term capital gain, 1 lakh is exempted, 54 lakhs at the rate 10% plus surcharge at the rate 15%, and other incomes, tax on 1.3 crores at the rate slab rates, and on this slab rates surcharge at the rate, generally if the income has exceeded 2 crores, we are going to levy surcharge at the rate 25%, but here 15% only. This is the special case. If we do not include capital gains, if the income is below 2 crores, in such a case, even though the inclusion of capital gain has exceeded 2 crores, surcharge at the rate 25% shall, 15% shall only be levied. This is the benefit available to the SSE. Okay. So these slab rates were regarding individual, HUF, AOP, BOI and artificial judicial person. Okay. Next, coming to our further discussion, assessment of firms, LLPs, local authorities and cooperative societies. So what they have specified here is when the total income exceeds 1 crore, if the total income has exceeded 1 crore, what they have specified here is surcharge at the rate 12%. Very simple. There is no concept of slab rates here. In case of firms, LLPs and local authorities, if the income has exceeded 1 crore, in such a case, surcharge at the rate 12% has been specified. So here there is no discussion on slab rates. Below 1 crore, no surcharge. Above 1 crore, surcharge at the rate 12%. Okay. Next, this is very important. Surcharge in case of a company. In case of companies, what they are going to specify here is if company has opted section 115 BA or BAB, just now we have discussed 22% tax rate and 15% tax rate. In this case, surcharge is mandatory at the rate 10%. And coming to other SSEs, if the total income is between 1 to 10 crores, then surcharge at the rate 7%. If the total income has exceeded 10 crores, in such a case, surcharge at the rate 12%. Okay. So this was regarding surcharge in case of domestic companies. Okay. Next, coming for surcharge for foreign companies. Generally for foreign companies, tax rate itself is 40%. And if we levy surcharge at the rate 7% and 12%, it is going to be a big burden on such foreign companies, and hence in case of foreign companies 1 to 10 crores surcharge at the rate 2% only. Below 1 crore there is no surcharge on the foreign companies. 1 to 10 crores surcharge at the rate 2% has been specified, and when the total income exceeds 10 crores, here surcharge at the rate 5% has been specified. This is surcharge in case of a foreign company. Generally, if surcharge is being levied, we have a concept to claim marginal relief. If the tax exceeds the income, such excess amount can be claimed as marginal relief. Sir, how to claim this marginal relief is the discussion. For this purpose, I am going to present you an example here. Sir, many were asking regarding screen was not clearly visible. Sir, screen is very clearly visible in the top column, but what you need to do for clear visibility is you have to watch the video at a minimum configuration of 360p, so that screen will be very easily visible to you. So please watch the video at 360p configuration for greater clarity in the screen. Okay. Now coming back to our discussion in case of marginal relief. How to compute this marginal relief? When the income is 1 crore 1 lakh and when the income is 1 crore. Coming to a company, generally on 1 crore 1 lakh, tax at the rate 30% shall be levied. And when the income has exceeded 1 crore, surcharge at the rate 7% shall also be levied. In this case, 32,42,100 is the tax payable. But if the income is only 1 crore, for example, in such a case, what they have specified here is tax at the rate 30% and surcharge at the rate 7% nil, because whenever the income exceeds 1 crore in case of companies, then only the concept of surcharge arises. Here the income has not exceeded 1 crore, and hence the concept of surcharge does not arise. So here the tax is 30 lakhs only. If you compare these, here increase in income is 1 lakh. Income has increased 1 lakh, 1 crore 1 lakh and 1 crore 1 lakh income has been increased. But if you compare taxes, 2 lakh 42,100 has been increased. Income increase is only 1 lakh, but coming to tax has increased 2 lakh 42,100. Just for increase of 1 lakh income, no SSC will be willing to pay 2 lakh 42,100 tax, and hence excess of tax over the income, this 1 lakh 42,100, this is the tax payable. Out of the tax payable, this 1 lakh 42,100 can be claimed as marginal relief, and after claiming that marginal relief, then only education cess at the rate 4% shall be added. Okay, here is the net tax payable. So this has to be done in case of every SSC based on the categories, when the income is 50 lakhs and when the income is above 50 lakhs in case of individuals. So the same calculation you need to repeat, so that if the tax is higher than the income, marginal tax, that means income in excess, increase in income, like this you need to compute increase in income how much and increase in tax how much. If the increase in tax is higher than increase in income, then such difference, if you see here, increase in tax is greater than increase in income, then you can claim marginal relief is the conclusion. So I think by this the provision is very clear regarding the concept of marginal relief. And now coming to the concept of rebate under 87A. Sir, surcharge concept is already completed. So some were questioning me regarding the third category. Okay, I have already given you a clarification here. Category 1 general, category 2 if capital gain exists. This third category special case is nothing but I have given here fifth case. This is the third category. Okay, this calculation I have presented here. This is the third category of surcharge. Okay, right. Now coming back to our discussion. So we have concluded the concept of surcharge, and now coming to the concept of rebate under 87A. Many were aware, but here what was specified here is rebate under 87A is applicable only in case of resident individuals. What they have specified here is this is applicable for resident individuals. That means this rebate is not applicable for HUF, partnership firm. No one can claim this benefit. This rebate is applicable only for resident individuals whose total income has not exceeded 5 lakhs. Here rebate is normal tax payable or 12,500, whichever is less. For suppose if SSC has income of 4 lakhs up to 2,50,000 exempt, 2.5 lakhs to 4 lakhs, 5%. 5%, that means 1,50,000, 7,500 is the 5% tax. This 7,500 can be claimed as rebate under 87A. Okay, but when the income exceeds 5 lakhs, then there is no concept of rebate. Rebate under 87A is eligible only if the income has not exceeded 5 lakhs. Here income means total income but not gross total income. After claiming deductions, if the total income itself does not exceed 5 lakhs, then you can claim a rebate of 12,500 maximum. Here since it's only 7,500, rebate of 7,500 is being claimed. Okay. So coming to round off, income must be rounded off to nearest 10 rupees and tax also should be rounded off to nearest 10 rupees. We are aware of this point. And now coming to the special rates of income tax. So up to now I have many circumstances discussed regarding section 311A and above concept surcharge also. Many times we have repeated this term section 311A, capital gain tax rate. What does section 311A specify? Here is short term capital gain arising on transfer of equity share in a company. If you are going to transfer a equity share in a company or mutual funds, they are of two categories, debt oriented and equity oriented. More than 65% of the capital, if it was invested in equity shares, then it is called as equity oriented fund, one of the category of mutual fund. Even this mutual fund units were sold or units of business trust. So here we have separate section, units of business trust. In day 9 we are going to have a complete discussion on the concept of business trust also. So like mutual funds, it is also one form of investment to encourage the real estate sector to raise their capital. A concept of business trust has been introduced, which shall be discussed at some later point of view. And now we are going to have a discussion here that if these three shares were being sold, equity shares, not preference shares, listed equity shares, listed units of equity oriented fund, listed units of business trust, what I have specified here is listed because STT has to be paid. If STT is not paid, then normal tax rate only. Only when if the STT has been paid, tax at the rate 15% has been specified. If STT is not paid, normal rates has only been specified in this case. Only if STT paid only, then a special tax rate of 15% has been specified in this case. Okay. This is section 311A. Coming to long-term capital gain. Sir, general long-term capital gains 20% tax. Generally on every long-term capital gain 20% tax. But section 112A has specified that listed equity shares, listed units of equity oriented fund, listed units of business trust. If short-term capital gain arises, here we are going to pay tax at the rate 15%. But if long-term capital gain arises on sale of these securities, if long-term capital gain arises on sale of these securities, in such a case, up to 1 lakh we can claim exemption. There is no indexation benefit. Out of full value of consideration after reducing expenses, direct cost of acquisition to be reduced. Here we should not reduce indexation. We should not claim the benefit of indexation. Direct cost of acquisition should be reduced. And any long-term capital gain arises, what they have specified here is 10% special tax rate. So equity share in a company and equity oriented fund and units of business trust, if were sold on which long-term capital gain arises, a special tax rate at the rate 10% has been specified. A special tax rate at the rate 10% has been specified. Okay. Now coming to the discussion, up to 1 lakh, here we can claim exemption. Whether this 1 lakh exemption is on each security, no, on aggregate of all the shares sold. So for example, if I have sold Reliance Industries Limited share, where the long-term capital gain is 5 lakhs, and I have sold Tata Capital Limited share, long-term capital gain is 6 lakhs. So total long-term capital gain on sale of listed shares 11 lakhs. Out of this 11 lakhs, 1 lakh is exempted. You cannot claim 1 lakh exemption for each category. Here entire long-term capital gain 1 lakh exemption has been specified, and balance 10 lakhs in this case is liable to special tax rate at the rate 10% under section 112A is the conclusion. Okay. Next, coming to 112, other long-term capital gains. Generally, if I am going to sell a building, if I am going to sell unlisted shares, in such a case 20% category has been specified. Okay. So by this 112 section is very clear, and there is another long-term capital gain, listed securities on which STT is not paid. Here this is applicable only with STT is paid at the time of acquisition and transfer. Only if STT has been paid, then only this 10% tax rate has been specified. That means if STT is not paid, then what is the situation in such a case? If STT is not paid in case of listed securities, with indexation 20% or without indexation 10%, both calculations shall be made, and the provision which is beneficial to the SSE shall be followed. The beneficial provision shall prevail is the conclusion. Even this calculation is applicable in case of zero coupon bonds also. Even zero coupon bonds were being sold without indexation. With indexation we have, generally in case of zero coupon bonds, no indexation benefit is available. Okay, here 10% shall be specified, but a special benefit has been specified here, that listed securities and zero coupon bonds 10% without indexation and 20% with indexation, and which tax has to be paid, whichever is beneficial, whichever is lower shall be paid by the SSE. Okay. Sir, when an asset shall be called as long-term capital gain and when an asset shall be called as short-term capital gain? Here we have a complete discussion on capital gains in one of our session, day 4. So capital gain session, and very important 18 special cases, CA final or IPCC, on practically very important special cases also we are going to discuss in this capital gains chapter. So I will clarify it there regarding categorization of long-term and short-term. Now I have concluded the tax rates here, and balance discussion shall be continued on that day. And here coming to next category, winning from lotteries, crossword puzzles, racehorses, casual incomes, special tax rate at the rate 30% has been specified. And coming to anonymous donations, where trust does not maintain the identity of the donor. Donor details including their address details, recent contact number details should also be maintained by the trust. If the trust does not maintain the details of the donor, such donation shall be treated as the anonymous donation. Such anonymous donation shall be liable to tax at the rate 30% is the presentation. Okay. Next, coming to further points, number 6, section 115 BBE. This is a very important discussion. Now we are going to have section 68 to 69D. After this table, I am going to begin that discussion. And in case of life insurance business, a special tax rate at the rate 12.5% has been specified in case of life insurance business only. General insurance companies 30% shall be applicable. Only in case of life insurance companies, a special tax rate 12.5 has been introduced. And this 115 BBD, if a Indian company invests in a foreign company more than 26%, then this foreign company is called as specified foreign company, and any dividend out of this specified foreign company, 15% special tax rate has been specified. Let me conclude this. Who has to invest? Indian company has to invest. Where it is required to invest? In foreign company. How much it is required to invest? Minimum 26% of such foreign company. And what that foreign company is called as? It is called as specified foreign company. And if we are going to receive any dividend out of such specified foreign companies, any dividend received out of such specified foreign companies, that dividend is liable to tax at the rate 15% without any reduction of the expenses. It is liable to tax at the rate 15% is the conclusion. Generally here 30% shall be levied in case of companies, but in this dividend, since foreign currency is realized into India to give benefits, 15% has been specified. And this regarding dividend, dividend from Indian companies in excess of 10 lakhs, if we are going to receive a 10% tax rate has been specified. Aggregate dividend, if I am going to receive dividend from Reliance Industries, Tata Capital, etc., total dividend 15 lakhs. Here up to 10 lakhs we can claim exemption under 1034. In excess of 10 lakhs I have here 5 lakhs. On such 5 lakhs, special tax rate at the rate 10% has been specified. Okay. Next, in all the above cases, surcharge if applicable and health and education cess 4% should also be added. Except sixth case. What is the sixth case? Now we are going to have a discussion, very important. By this, basic concepts will be completed and then we can enter for residential status. And now coming here, section 68, 69, A, B, C and D. So let us have a discussion on these sections. First, beginning with section 68, cash credit. Even the term that was specified here is cash credit. If you refer the section, any sum created in the books of the account, that means, let me take an example. If this is the balance sheet, I am presenting it in a vertical form. If this is the balance sheet, if any sum is credited here, capital is okay, and rather than the capital, it may be a loans and advance, it may be a sundry creditors, it may be a provision, whatever may be. Any sum credited in the books of the account, when any sum is credited in the books of the account, what the SSC is required to give here is explanation. For suppose sundry creditors 50 lakhs. What the department now asks is schedule regarding that 50 lakhs. Who are the creditors who were in debt to you in excess of 50 lakhs? The department is going to ask. Then SSC is going to give a clarification. He has to give an explanation. He has to provide the schedule for that 50 lakhs. For suppose, if SSC provided a schedule A, B, C, D, etc., 2 lakhs, 3.2 lakhs, like this he has provided a schedule for 50 lakhs. Now the department asks external confirmation. So they need a confirmation from the counterparty, or government shall issue notice to Mr. A under section 131 subsection 1. So issuing a summons, they can issue summons, commissions. Here in this case, direct department can give notice to Mr. A, or they might ask explanation from external confirmation by the SSC from Mr. A. So department needs to confirm this 50 lakhs. Now if SSC does not provide any confirmation, or the confirmation provided by the SSC is not satisfactory to the department, I am going to give you here 2 points. In all the above cases, if SSC offers no explanation, if SSC does not offer any explanation, or explanation offered by him is not satisfactory, the explanation offered by the SSC is not satisfactory. In these cases, what they have specified is, if the SSC does not offer any explanation, or explanation offered by him is not satisfactory, then this sum which has been created, this is nothing but a dummy creditor. You are going to claim it as an expense under head purchases, which is not a real purchase, and hence on this unexplained amount, department is going to levy special tax at the rate 60%. And here we are not going to stop. Surcharge at the rate 25%. On 60, 25% means 15%. Plus health and education cess at the rate 4%, which comes to total 78%. And if we continue, section 271 AAC, a new penalty at the rate 10% shall be levied, that means 7.8, which comes to total 85.8% of tax. Practically very problematic issue for all the practicing CAs. This section 68 to 69C. When any sum has been credited in the books as a liability, or in balance sheet if SSC has any investments, if SSC has any investments, if this is a balance sheet, if SSC has any investments, if this was recorded in the books of the accounts, then no issue. But if it was not recorded in the books of account, and department has known the investment by the SSC by way of annual financial return or statement of financial transactions, whatever may be, if department has come to aware that SSC has not disclosed the investments. In SSC, SSC has made the investments which were not recorded in the books of accounts, or the explanation given by the SSC is not satisfactory. And not only that, if the department goes for search and finds out any money, bullion, jewelry, etc., and SSC has to give explanation how he has earned, whether it was recorded in the books of account. If this was not recorded in the books of account, or explanation given by the SC is not satisfactory. And another important discussion here is unexplained expenditure. Sir, here 69 is regarding unexplained investments. This is unexplained money, bullion, jewelry. And if it was not fully disclosed, if SC has purchased a building for 1 crore, but in books of account he has disclosed that he has purchased it for 70 lakhs only. That means 30 lakhs has been invested out of his black money. This 30 lakhs is liable to special tax rate at the rate 60%, surcharge at the rate 25%, plus health and education cess at the rate 4%, plus penalty at the rate 10%. It's a very, very stringent provision. Let me clarify once again. Tax at the rate 60%, and here surcharge at the rate 25%, health and education cess at the rate 4%, total 78%. On this 78%, along with this, the department shall also levy penalty. How much the penalty department is going to levy? 10% penalty shall also be levied generally. So here, what the conclusion we are going to give is, in case of undisclosed incomes under section 68 to 69D, if SSC does not offer any explanation, or the explanation given by the SC is not satisfactory, in such a case, what they have specified here is, SSC is liable to pay the higher tax rates. The sum charged shall be special tax rate at the rate 78%, which is a very, very difficult provision. And now the department is also levying interest under section 234 ABC also on this special tax rate. It becomes higher of 100%. A very, very difficult provision practically. And here is also another provision that regarding unexplained expenditure. What they have specified here is unexplained expenditure. Sir, what do you mean by the term expenditure? If any expense was not recorded in the books of accounts, for example, if in P&L account, SSC has shown rent of rupees 15 lakhs, but actual rent paid by the SSC is 25 lakhs, but he has recorded only to the extent of 15 lakhs in the books of account. That means the SSC has certain expenditure 10 lakhs, but which was not recorded in the books. That means he has spent out of his black money. This 10 lakhs shall be regarded as the income of the SSC. Here there might be a question that, sir, this 10 lakhs is the income, but he has paid rent amount. Rent can be claimed as deduction under section 30. So what they have given conclusion in this case is, in case of unexplained expenditure, no deduction cannot be claimed as deduction. Even out of this incomes, past losses also not permissible to be set off. Even past losses also were not permissible for set off. So losses cannot be set off, and any deductions cannot be claimed out of this special tax rates. So very, very practically harsh provision based on department point of view, but they have introduced this provision after completion of the scheme of IDS, after completion of income declaration scheme, which was introduced during 16-17 previous year. So in such a case, what they have specified is, there we need to pay tax at the rate 45% in IDS scheme on fair market value. Since many of the SSCs have not entered to that IDS scheme, the government has introduced this provision of 78%. And even at the time of demonetization, many of the people has made deposits in the books of accounts, that means in bank accounts. And those deposits, the department is asking for the explanation. SSC is specifying that it is a regular sale, but the assessing office is not accepting it as a regular sale, because past notes were being discussed, old notes, 500 rupee notes and 1000 rupee notes were being deposited. How the SSC can support that this was the regular turnover of the SSC? With effect from 8th November 2000, they have specified that after demonetization, after the change of the notes, what they have specified there is, the SSC is liable to accept only the new notes, but practically many of the SSC has accepted old notes and deposited to the bank. The assessing officer is considering it as the income before introduction of this demonetization scheme, so that a higher tax rate has been specified here. So support of this is very practical, problematic issue, but since the act has been constituted, we need to follow them. If SSC offers this as income in the regular income tax filed by the SSC, then higher tax rate is only 30%. If SSC has a black money of 50 lakhs, in current year if we are going to offer it as income, we shall pay highest tax of 30% plus relevant surcharge. But now if we are not going to disclose in our return of income, in future department points out the transaction, now we are liable to pay special tax at the rate 78% and also penalty under 271 AAC. So it would be better that the conclusion I am going to give is, every year the relevant income must be completely shown by the SSC. If it was not clearly disclosed, then he is liable to pay higher provisions, higher taxes. Rather than that, it would be beneficial to the SC to offer income at relevant assessment years. Okay. Now coming to next provision, loans borrowed or repaid on hundi. Now in a present scenario, borrowal through hundi is very irregular. But if any rolled areas, any borrowal has been made by way of hundi loans, in such a case, what they have specified there is, it has to be accepted by way of account pay check. Practically, they were not borrowing these hundi loans. Practically, if they are going to borrow any secured and unsecured loans, we have provision under section 269 SS and 269 T that in excess of 20,000 cannot be borrowed and cannot be repaid. So this was practically been followed by us. 69D is very irregular. So hence, on these 68, 69, 69 ABC, special tax rate has been specified at the rate 60% under section 115 BBE is the conclusion. Okay. So by this we have completed the provisions regarding the 68, and next let us continue with the second topic. Here today what the topics we have listed out is basics, surcharge, tax rates, and next we have completed section 68 to 69D, and now coming to residential status and its incidence of tax. So generally basics were, many of us are aware regarding the basics. So let me conclude the basics in a easy manner, and after that I shall enter into the concept in a detailed manner regarding income deemed to be accrued or erased in India. Here in this case, residential status of an individual. Sir, I am going to specify the term regarding the previous year 1920, that means assessment year. I am going to specify provisions of residential status. Actually, in Finance Act 2020, certain provisions regarding residential status have been modified, and later they have specified that modified provisions were not applicable. So it shall be discussed at a later point of time. But now we are discussing on Finance Act 2019. Based on that, what they are specifying here is, here the basic conditions. If the SSC is in India for 182 days or more during the previous year, or he is in India for 60 days or more in the previous year, and 365 days or more during 4 years immediately preceding the previous year. So what they have specified in this case is basic conditions. In the previous year, if SSC is in India for 182 days, or, so here we have two basic conditions. Even one of the basic condition is being satisfied, then SSC is called as resident. When one or both the conditions were satisfied. Okay. When none of the condition is satisfied, then he is called as non-resident. Very easy provision. And along with residential status, now we need to classify whether the SSC is a ordinary resident or not ordinary resident. Here we need to get a clarification. Additional conditions, if you refer first part, both the additional conditions have to be satisfied here. Last 7 years he has to be in India for 730 days, and last 10 years he has to be resident in India for 2 years. So resident means basic conditions have to be satisfied for 2 years out of the past 10 years. When these two conditions were satisfied, then in such a case it shall be called as resident and ordinary resident. And when none of the conditions were satisfied, what they have specified here is resident but not ordinary resident is the conclusion. So finally here we have clarified here that resident and ordinary resident, resident but not ordinary resident, and non-resident, we have categorized them into 3 parts. And now we need to calculate the tax rates applicable in these 3 cases. So tax rates already have been discussed, but now I am focusing on incidence of tax, how we are going to levy taxes on them. Here I have categorized them, section 5, into 8 categories: resident and ordinary resident, resident but not ordinary resident, and non-resident. Here I have categorized them into 3 categories. So based on that, now we are going to have a discussion. Number 1, income received in India. Sir, what we have now discussed is residential status. When an SSE is called as a resident, when an SSE is called as a resident and ordinary resident, when an SSE is called as a non-resident. So we have discussed it from basic point of view. Once we have decided the residential status, and now we are required to do is incidence of tax. That means what are the incomes on which resident is liable to pay taxes, and what are the incomes on which non-resident is liable to pay taxes. That incidence of tax concept is being discussed now. Here, if the income is received in India or if the income is accrued in India, what they have specified here is 2 parts. If the income is received in India or if the income is accrued in India, he may be a resident, ordinary resident, not resident, whatever may be, taxable for all the SSEs. If the income is received in India or if the income is accrued in India, these 2 points, either accrual or receipt, whatever may be. For suppose if a person is being employed in America but he is going to receive salary in India, even though he is in employment outside India, but the income is received in India. Since the income is received in India, it is taxable for non-resident also. Sir, he is employed outside India, why he is liable to pay tax in India? This is the provision. If he is liable to pay tax at USA, America, and also at India, then he need to use the concept of DTAA, double taxation avoidance agreement. If an income is taxed on accrual basis in one country and on receipt basis in another country, an SSE is not liable to pay taxes at both the countries. It may lead to double taxation. For that purpose, what they have specified here is double taxation avoidance agreement. We are going to have a discussion on this topic in day 14. So don't bother regarding double taxation. How to claim the benefits? We have 2 types of reliefs, unilateral relief and bilateral relief. How to compute and what are the forms required to be filed for claiming DTA benefits shall be discussed at later point of time here in the schedule in day 14. And now coming back to our discussion, here 4 categories. These 4 categories, if the income is received or accrued in India, this is taxable for all the SSEs, resident and ordinary resident, non-resident, or resident but not ordinary resident. For all the SSEs, this is taxable. But here the important discussion is these 4 categories. These 4 categories, 5 and 6 categories discusses with business or professional income. If SSE has any business income or professional income, in such a case, what they have specified is, sir, in these 4 categories, either receipt is in India or accrual is in India. If any one thing is in India, then we are going to levy tax on all the SSEs. If it leads to double taxation, they can claim DTAA benefits. But coming to point number 5 and 6, if the income is accrued and received outside India, sir, in first 4 categories, either accrual or receipt is in India, and hence we are going to levy the taxes. But coming to fifth and sixth categories, either accrual or receipt, both not either, both income accrued and received outside India. If both were received outside India, but business is controlled from India or profession is set up in India, what they are specifying here is, even though the income is accrued and received outside India, the business is controlled from India or the profession is set up in India. Here, non-resident is not liable to pay taxes. ROR and RNOR were liable to pay taxes because they were residents of India. Even though the business is located outside India, here, since the control is from India, it shall be regarded as, sir, for suppose profession, if a hospital has been set up in India and its branch is being located outside India, the profession which was set up in India, if a branch is being set up outside India, in this case also, for ROR and RNOR, it shall be liable to pay tax, and non-resident of India is not liable to pay the taxes. Okay. And in fifth category, even though the accrual and receipt is outside India, here control is in India. But in sixth category, that control is also outside India. That means accrual outside India, receipt outside India, control is also outside India. Since everything is outside India, we cannot tax resident but not ordinary residents and non-residents. But we are going to levy tax on ROR because he is in India for 182 days during the previous year. Last 7 years he is in 730 days in India. And last 10 years he is 2 years a resident of India. That means he has satisfied basic and additional conditions. Such ROR is always liable to pay tax in India. So in a simple terms, ROR global income is liable to tax in India is being specified in this case. So finally, if the income is accrued and received outside India or a business controlled from outside India, profession which was set up outside India, since everything is outside India, we cannot tax the income in India. But if the SSE is ROR, then we are not going to leave him. It is liable to pay taxes in India. Okay. And next, coming to category number 7, other incomes accrued and received outside India. Sir, what do you mean by the term other incomes? Salary, house property, capital gain or other sources. And other than PGBP, if there are other incomes which were accrued outside India and which were received outside India, in such a case, what they have specified here is, since everything is outside India, we cannot tax RNOR and non-resident. But even though the other incomes were outside India, the person is in India. He has satisfied basic and additional conditions. So simply speaking, resident and ordinary resident is always liable to pay tax in India is the conclusion. His global income is liable to pay tax in India. Sir, if this income is taxed outside India also, then you are suffering double taxation. Then you have to claim the benefits of DTAA. The DTAA benefits shall be discussed at a later point of view. And now, very, very important practically, income of earlier years, not income of current year, income of earlier years remitted to India during the previous year, whether taxed or untaxed. For suppose, in previous year 15-16, if I have earned 10 lakhs in America, and such income I am going to bring it to India, whatever may be the purpose, for a building construction or charity, whatever may be, if I am going to bring the income from outside India to India, which income earned in earlier year, which was remitted to India during the previous year, is liable to pay tax? Answer is no. They are not liable to pay tax. It is not taxable for any SSE, even though the SSE is ROR. If earlier income, past year incomes were being remitted to India during the previous year, it is not liable to pay tax by any SSE is the conclusion. ROR, RNOR, RNR, whatever may be, no person is liable to pay tax. So here, these 8 categories were very, very important for examination purpose and also practically. So let me revise it in a easy manner. If the income is received in India or accrued in India, it is taxable for all the SSEs. Sir, what do you mean by the term deemed to be received? Okay, here I am going to give you a clarification. RPF contribution is exempt to the extent of 12% of salary. if 15% of salary is contributed, this difference 3% shall be deemed to be received in India. If you refer salary chapter, if employer contributes 15% of salary, if employer is going to contribute 15% of salary, their exemption under section 10 is to the extent of 12%. Balance 3%, even though the employee does not receive, in this case employee is not going to receive this 3%, but this 3% shall be deemed to be received by the employee and it is taxable under the head salary. So this is deemed to be received. And regarding interest also, interest created to RPF in excess of 9.5%. If interest at the rate 12% is accrued in Provident Fund account, exemption is to the extent of 9.5% only. Thus different 2.5% is taxable. Even though it is accrued but not received, it shall be deemed to be received by the SSE. Even contribution to pension funds also, 80 CCD deduction is to the extent of 10% only. If employer contributes 15% of salary to pension funds, exemption to the extent of 10% only. Balance 5% which was contributed to pension fund is taxable in the hands of employee under the head PGBP. Okay, sorry, under the head salary. If it is a pension scheme, it is taxable under the head salary. That means to the extent of this 12%, 9.5%, 10% excess amount shall be taxable. It shall be deemed to be received by the SSE is the conclusion. Even transfers from URPF to RPF. Sir, actually URPF receipt is taxable. Receipt from URPF is taxable. Receipt from RPF is exempted. Okay. But if URPF converts to RPF, generally RPF withdrawal is exempt. But balance which was transferred from URPF to RPF, that amount, for suppose, if the amount in URPF, unrecognized provident fund, is 5 lakhs, which is being converted to RPF, now employee is retiring and withdrawing 6 lakhs. This 6 lakhs is exempted because it was withdrawn from RPF. But when it was converted from URPF to RPF, such conversion itself is liable to tax. On this 5 lakhs, SSE is liable to pay tax because converted amount, transferred balance shall be deemed to be received in India. So this is categorization regarding deemed to be received. So let me conclude it. So if the income is received in India or if the income is accrued in India, in these two cases, SSE is ROR, RNOR or NR. In all the three cases, it is taxable. But now if the receipt and accrual both were outside India, but if the business is controlled from India or profession is set up in India, in such a case category 5, which is taxable for ROR and RNOR. And coming to category number 6, if the income is accrued outside India, received outside India, but the business is controlled also outside India. Here the control is in India, but here control is also from outside India. It is taxable only for ROR only. Okay. Next, coming to 7th point, other incomes. If they were accrued and received outside India, only for ROR only, he is liable to pay taxes. 5th and 6th categories is only business or profession income. 7th category is regarding the other incomes. And 8th category, very very useful. Earlier year income, if remitted to India during the previous year, it is not taxable for any SSE is the conclusion. So here we need to have a clarification on this topic, income deemed to be accrued in India. So if you come here, so we have completed the residential status and its incidence. Now we need to discuss the income deemed to be accrued or erased in India. What do we mean by the term deemed? Now the balance time we are going to invest in this income deemed to be accrued or erased in India. So sir, income deemed to be accrued or erased in India, I have categorized them into 8 points, in which 8th point all the practicing CAs and also the students who are going to write in exams, 8th point is very 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 important practically. And first 1 to 7 points for existing provisions, but this 8th point has been introduced in the act by way of Finance Act 2. What they have specified here is Finance Act 2 has been specified 8th point, and remaining 1 to 7 points were applicable for past years also for all the SCs. 8th point has been newly introduced. So let us go in a phased manner regarding these points. Sir, here we have 8 points. Income deemed to be accrued, very difficult to understand, but we can discuss it in a easy manner. I have categorized them into 8 points. Okay. So now coming to point number 1. Here we have 3 subtopics, A, B and C. A, B and C. Coming to point number A. Income from business connection. Income from business connection. Sir, what do you mean by the term business connection? Sir, once again I am going to give you clarification that income deemed to be accrued or erased in India is taxable for all the SSEs. If you refer our incidence of tax, income deemed to be accrued or erased in India is taxable for all the SCs, and hence we need to clearly interpret this term income deemed to be accrued or erased in India. So hence now I am going to give you a conclusion that income from business connection, income from business connection. Okay, income from business connection. What do you mean by the term business connection? If SSE has a branch, depot, agency, service center, factory outlet, whatever may be, any activity in India that leads to profits. What they have specified here is any activity in India that leads to profits. So if SSE carries on any activity, branch, depot, whatever may be, if that activity leads to profits in India, for example, if a non-resident, if a company which was incorporated in America has a branch in India, this branch shall be treated as a business connection. This branch is liable to pay tax in India because it shall be deemed to be accrued, business connection. So not only a branch, even if it has an agent in India, that is also liable to pay tax in India. So business connection means if any entity in India secures orders, if in India any unit is going to secure the orders or maintaining the stock or collecting the payments or making payments and concludes the contract, then it shall be treated as income deemed to be accrued in India. Let me clarify you once again. Income from business connection shall be income deemed to be accrued or erased in India. What do you mean by the term business connection? Any activity in India that leads to profit shall be treated as a business connection in India. So what? Business connection, if it exists in India, the income arising shall be deemed to be accrued in India. When an SSE shall be treated as he is having a business connection in India. If in India, if he secures the orders or maintains the stock and concludes the contract, in such a case, it shall be treated as SSE having a business connection in India. For suppose, if person Mr. A is located outside India and I am his agent in India, I am going to secure orders in India or maintain stock in India on behalf of that non-resident, or I am going to collect the payments and remit to him. I am acting as an agent in India. In such a case, the profits arising for that non-resident out of the transaction made in India shall be taxable, income deemed to be accrued or erased in India. Let me give you one more clarification, okay? So that very confusing topic, but we can present it in a easy manner. For suppose Mr. Z, a non-resident, manufacturing cost of a product is 5 lakhs and he is going to sell the product it for 6 lakhs. This non-resident has an agent, Mr. A, in India, and this product is being sold to customer Mr. C for 6 lakhs. Now here Mr. Z is having a profit of 1 lakh. This 1 lakh, whether it is taxable in India or not is the question, and I am going to conclude here that if this agent who was located in India, it means that this agent having business connection in India, this profit 1 lakh which was sold through this agent, even though this 1 lakh is arised outside India, Mr. Z is liable to pay tax on this 1 lakh in India because it shall be treated as business connection. Any activity in India, you are having an agent in India, you are going to sell the product through the agent in India. In such a case, took Mr. Customer C, the profit which was arised 6 lakhs. I am not going to bother about the commission of this agent. Commission of this agent is not the criteria. The thing which was required here is the profit arised to the non-resident 1 lakh is also be liable to tax in India because they have business connection. So what I am going to give conclusion is any activity in India that leads to profits shall be liable to pay tax in India. But we have certain exceptions. What do you mean by the term exception? Even though business connection exists, nothing shall be taxable in India. What are those? Sir, here, if this agent is an independent agent, that means this agent deals with not only Mr. Z products, Y, X, T, U, W, different persons products this agent A deals with. That means if he is a agent who deals with many of the non-resident products, in such a case, what it has discussed here is exception to the business connection. Generally, if a product is sold through agent in India, the profits arising shall be liable to tax in India. But if such agent is an independent agent, that means more than, he does not deal with any product more than 51%. If he deals our product more than 51% of his turnover, then he shall be treated as an agent and the profits arising shall be liable to tax in India. But if this agent is an independent agent, that means in this case what they have specified is he deals with different company products, not only our company products, he deals with many company products. Such agent is called as independent agent. If this Mr. A is an independent agent, this profit of 1 lakh is not taxable in India. This profit is taxable in India only if he is an dependent agent. If he is an independent agent, none of the profits shall be liable to pay tax in India. This is the first point. Exception. So generally if business connection exists in India, then it shall be taxable in all the cases if business connection exists in India. But in these exceptions, even though the business connection exists, nothing shall be taxable. The first exception that was specified here is independent agent. And second exception was goods purchased in India for the purpose of export outside India. Let me give an example. A, who is a non-resident, purchased goods in India for 6 lakhs. He was located in USA and he has sold the goods to New Zealand. That means he has purchased in India for the purpose of export outside India for 7 lakhs. In this case, if he purchases for 6 lakhs in India and sells the same good for 7 lakhs in India only, then the profit of 1 lakh shall be liable to pay tax. But what I am going to give you here is, if this non-resident purchases the goods in India for exporting outside India, then this profit of 1 lakh is not liable to pay tax in India. That means income deemed to be accrued or erased in India, what they have specified here is, if any person is going to purchase the goods in India for the purpose of export outside India, the profit arising on such sale is not liable to tax. This is exception number 2. Coming to exception number 3, if any foreign newspaper collects news from India and publishes them outside India, that profit is also not liable to pay tax. Even though news collection activity is conducted in India, it is not liable to pay tax on this news collection activity. And shooting of films in India. Sir, if a non-resident, all these exceptions were applicable for non-residents only. If you refer here, all these exceptions were applicable for non-residents only. If a non-resident comes to India for a film shoot, if in India any location, if a non-resident shoots any film in India and such film upon its telecast has erased any profits to the producer, even though the shooting activity is done in India,
the profit arising on telecast of such film is not liable to pay tax in India, because they need to encourage the shooting of films in India. They need to encourage the news collection activity in India. So in order to encourage them, what they have specified here is exceptions. Exceptions means nothing shall be liable to tax. Independent agent, purchase in India for the purpose of export, collection of news in India, and shooting of films in India. In this case, even though the non-resident earns income in India, nothing shall be taxable. And these three provisions, practically they were not useful. Here, in case of mutual funds, if a foreign mutual fund has a fund manager in India, Indian mutual funds, at the time of their distribution, they shall be liable to pay dividend distribution tax. But a foreign mutual fund, even though it has a fund manager in India, that means a fund management activity is being conducted in India, such fund management activity is not liable to pay tax. So for all the SSCs, this is not useful. This is useful only in case of mutual funds. And this is also in case of mining companies. Since we have scarcity of crude oils, if a non-resident has a unit in India for the purpose of sale of crude oil, they have certain exemption under section 10 subsection 48A. So these exceptions were useful to relevant businesses only, not for all the SSCs. But in order to have a knowledge regarding these exceptions, I have made a focus here. By this we have concluded point number 1A. This is only very big item in this income deemed to be accrued or erased in India. And now let us go for small issues. This is very simple. I will present you with an example for clarification. If Mr. Jed, who was located in Australia, has a building in India, okay, now this Mr. Jed has let out this building to Mr. A, who was located in Japan. This Mr. A needs to carry a business in India. For that business purpose, he requires a building. So this building has been taken on lease from Mr. Jed. That means the owner of the property is a non-resident. The tenant is also a non-resident. Whether the rent paid by Mr. A to Mr. Jed, for suppose if the rent paid in Indian currency is 5 lakhs, whether this 5 lakhs is taxable to Mr. Jed. Here the property is let out to a non-resident. Whether this let out receipts, let out by a non-resident to a non-resident. Even though the property has been let out outside India, the property which is being let out is located in India. So even though rent has been paid outside India to outside India, since the property is located in India, this rent of 5 lakhs is taxable in India is the conclusion. So I think this point is very clear. And coming to next thing is that if this property has been sold, this capital gain arising on this property also, even though sale is made by a non-resident to another non-resident, the building is located in India. If the building is located in India, then income shall be deemed to be accrued or erased in India, and hence it is taxable is the conclusion. So I think these three provisions were very clear. So once again I am going to give you a conclusion in this case is that if Mr. Jed, who is located in Australia, who was a non-resident, has let out or is going to sell his building to a non-resident outside India, if he is going to let out the building or if he is going to transfer a capital asset outside India, whatever may be the case, in these two cases what they have specified here is income shall be deemed to be accrued or erased in India. This question has arisen because a non-resident has sold the building to a non-resident, or a non-resident has let out a building to a non-resident. Since entire thing has been done outside India, why the liability to pay tax arise in India is the question. Because the property, that means building, is located in India. Since the building is located in India, the rental income or property, if it was sold, any capital gain arising, both were liable to pay tax in India under the category income deemed to be accrued or erased in India. Okay. So this is point number 1, and total we have 8 points in deemed to be accrued or erased in India. We have concluded first point by dividing it into categories A, B and C. Now coming to second point, salary received outside India for services rendered in India. So very interesting topic here. The service is provided in India, but employee is going to receive salary outside India. Even though the salary is received outside India, he is in a temporary employment in India. In such a case, since he has rendered the services in India, the salary received shall be taxable in India is the conclusion that was given in this case. So since it shall be deemed to be accrued or erased in India, that means the provisions of TDS were very important here. On the salary, even though the salary is received outside India, employer is liable to deduct TDS in India because the service is rendered in India. So many of the High Court and Supreme Court judgment exist in this point. Even though the salary is received outside India for the services rendered in India, even though he is a non-resident, since the service is rendered in India, entire salary is taxable is the conclusion. Okay. Coming to point number 3, this is very important. If our government employees were being employment at embassies outside India, Indian embassy is located in foreign countries. If the employees were at outside India, but the salary is paid by government of India, that means they are working outside India. That means salary accrued outside India, and salary is also received outside India. But the salary is paid by government of India. Since they were government employees, even though they were working out at embassies outside India, that salary shall be liable to pay tax in India only. So this is point number 3, very important. What they have specified here is the salary received from the government of India for the services rendered outside India is taxable. So even though the salary is received outside India, even though the salary is accrued outside India, since it was received from the government of India, it is taxable is the conclusion. But however, perquisites and allowances, if he is going to receive outside India any overseas allowance or overseas perquisites, they were exempt under section 10 subsection 7. Only salary shall be taxable in India. And coming to point number 4, now dividend in excess of 10 lakhs received by non-resident is also taxable. Resident or non-resident, whoever may be, aggregate dividend from Indian companies, if it exceeds 10 lakhs, they are liable to pay special tax rate at the rate 115 BBDA section at the rate 10% shall be levied. Okay. Sir, I am going to specify this based on Finance Act 2019. Finance Act 2020 has brought many changes in dividend distribution. Now dividend distribution tax has been taken out from the system, and complete dividend is taxable for recipients only, is the amendment which was released in Finance Act 2020. But now we are focusing on Finance Act 2019 because now during filing of income tax returns, we are going to file returns for the assessment year 2021, and hence based on that only we are going to have a discussion. And here coming to next point, point number 5, 6 and 7. So these 3 points at a stretch I am going to have a discussion. Interest, royalty, technical fees received. If the interest is paid by government of India, then it is taxable always. He may be a resident, non-resident, whatever may be. Interest payable by government of India is always taxable in the hands of the recipient. If interest is paid by a resident, for suppose A is paying the interest, okay, and B is receiving the interest. Since interest is received by B, this B is liable to pay tax on interest in India only if A is a resident. If the interest is paid by a resident and A is utilizing the fund completely in India, then only in the hands of B it is taxable. So some confusing element, but I am here to clarify you that if interest is paid by government of India, then in the hands of recipient it is always taxable. And coming to second point, if interest is payable by resident of India, then in hands of the recipient it is taxable only if such borrower, that means Mr. A, used the fund for the purpose of activity in India. In India he may use it for any purpose. For any purpose, if he is going to use it in India, then the interest paid on such borrower is taxable in the hands of the recipient, is the conclusion. And coming to third part, if interest is payable by non-resident, if non-resident pays the interest, that means if A is a non-resident, B is liable to pay tax on this interest if the fund is used for, this borrowal amount is used for business purpose in India. Here, three categories we have divided it. If interest is payable by government, then for receiver it is always taxable. Number two, if interest is payable by resident, then for receiver it is taxable only if the borrower has used the fund in India. For which purpose? Any purpose. Here, any purpose is permissible. But here, they have focused on business purpose only. If interest is payable by non-resident, in the hands of the recipient, such interest is taxable only if the borrower has used for the business purpose in India. The borrowed funds, if it was used for only business purpose in India, then only it is taxable. Okay. So these three elements, interest, royalty, fees and technical services, these three items were taxable in the hands of recipient. For example, if you are going to pay me interest, if you are going to pay me royalty, if you are going to pay me technical fees, it is taxable in the hands of recipient. I am going to receive interest, royalty and technical fees. For me, this interest, royalty and technical fees is taxable based on you. If the person who is going to pay you interest, if you are going to pay me interest, for me the interest is taxable. If you are a government, for me the interest is always taxable. If you are a resident, for me interest is taxable only if the fund is used in India. If you are going to use fund in India, then interest paid by you is taxable in the hands of me. And next, if you are a non-resident, if you are going to pay me any interest and I am liable to pay tax, if you use the fund for business purpose in India, then only I am liable to pay tax. So these are all the categories. And coming to point 8, very important, practically all the members in practice and also students for examination purpose, very important aspect. So after completing this one, we are going to conclude our discussion. So now coming to gift. Sir, gift section 56, we are going to discuss in detail in day 5, other sources, deemed dividend, gift provisions, we are going to discuss here. But now I am going to give you a clarification that gift, donor, receiver. For suppose A is the donor, B is the receiver. Gift amount is 50 lakhs. Whether this 50 lakhs is taxable in the hands of Mr. B is the question. Now let us have a discussion on this element. If A is a resident, B is also a resident, if A is a resident, B is also a resident, then taxable in India. Okay. Next, coming to second point. If A is a resident, donor is a resident, and receiver is a non-resident, okay, and donor itself is a non-resident and receiver is also a non-resident. Donor is a non-resident, receiver is a resident. These are all the 4 circumstances to be discussed. Okay. Sir, one thing, the provisions of gift section 56 has certain exceptions. Provisions of section 56 has certain exceptions. Exceptions, gift from relatives, gift on the occasion of marriage. We have certain exceptions which we are going to discuss it in income under the head income from other sources. Later we are going to have a discussion on that. But here what we are going to conclude is if a non-resident gives any sum to a resident of India, which is not covered in exceptions, they are not relatives. Let us take an example that these are unrelated persons. In such a case, this gift is taxable. Okay. Now, this category number 2 and 3 is the amendment. Gift received by a non-resident from a resident or non-resident. If this gift is given out of a source in India, the gift given by Mr. A is out of a source in India. A has earned the income in India. This income is being given as gift by A to B. If the source of the gift is in India, in such a case, it is taxable. If the source of a gift is outside India, then it is not taxable. This is the conclusion. So I think this provision is very clear. This is the amendment, sir. Earlier, the gift received by non-resident shall not be taxable, because if you remember our categories, let me show it once again. Just now we have discussed various categories, 8 categories. Yeah. So here, gift, if it was received by a non-resident outside India, it is not taxable. Gift received outside India by a non-resident is not taxable. But now it is taxable only if the source of income is in India. This is very, very important amendment, very practically useful. Let me once again clarify you. So here is the provision. Gift received by a non-resident from a resident. So since the source of income is in India, it is taxable is the conclusion. So here I have presented to you in an easy manner. If the source of income is in India, then it is taxable. If the source of income is outside India, then it is not taxable. Earlier, this is also not taxable in India. But now, the gift received by a non-resident, which was given by a resident, is taxable in India because it has been included in income deemed to be accrued or arranged in India. Finance Act 2 with effect from, if you refer the date here, with effect from 5/7/2019. That means Finance Act 2 has introduced this concept. Gift received by a non-resident from a resident of India is always taxable. So in order to eradicate the transfer of funds from India to outside India, other than by way of gifts, if loan is being given, it's a different issue. But here they are transferring the funds by way of gift. That means funds in India were being transferred to outside India. So in order to control the inflation, control the dollar rate, government has taken this step that the gift received by a non-resident from resident is taxable in India under point number 8. So we have 8 points which we have discussed in income deemed to be accrued or arranged in India. So by this we have completed our discussion on all the categories that we have specified here. Basic concepts, section 68, residential status, and income deemed to be accrued or arranged in India. So all these 4 categories, as we have planned today, we have made a discussion. So actually it's a revision course, crash course, and hence we are going to main focus on the tax element only rather than examples. We are going to straight away focus on the discussion, the provision directly, rather than the background and what are the further consequences. Rather than that, from examination point of view and practice point of view, we are going to straight away concentrate on the provision only. Okay, so this is like a revision session, this is like a crash course. So and the amendments which were useful for exam and practice, those are all the items we are going to discuss here. And based on our today's discussion, and some queries has been raised in the middle through live chat, but I have maximum covered in the discussion itself. But some have raised some certain queries that, sir, goods purchased in India for export and then sold in India, is the profit taxable? Yes, it is taxable. If purchased in India and sold outside India, then only it is not taxable. If purchased in India and sold in India, then it is taxable. Okay. So this is the provision that was discussed. Sir, if you have any doubts, so you can present it in a live chat discussion only, but present the doubt in a straight manner. Rather than specifying me the facts of the case, you direct question me the provision, that means the conclusion you require, yes or no type. So for suppose here they have a question that gift by non-resident to non-resident, then what is the taxability? Nothing is taxable. Gift given by a resident to a non-resident is taxable. Gift being given by a non-resident to non-resident is not taxable in India. So like that, if you put a straightforward question, I will conclude it at the end of our session. Daily after concluding our discussion, I will also clarify your doubts also. And here there is another question. Gift from non-resident to resident out of the income arised in India, will it taxable, or it is taxable only if received by resident to a non-resident? Okay. Sir, I have given you a clear clarification in this chart itself. Gift given by a resident to non-resident is always taxable in India. So gift, if a non-resident gifts any sum to a resident, it is also taxable. Only if I non-resident to non-resident is only not taxable is the conclusion. So I have already clarified here, and this video is also available in this link. Later point of view also, you can rewind the video and you can play, so that it might be very useful. And many of the queries were raised regarding the language to be used, regional language or to be completely to be dealt in English. Regional language might be useful for the people who were located in AP and Telangana, but the seminars were being conducted here based on all India basis, so that the English I am going to use it is in a very easy manner. I am not going to use any technical terms. So in a very easy understandable manner, I am going to discuss in a very slow and understandable language, so that you might not feel any query based on this. And if any query is being raised, you can raise it in live chat, and we will conclude it at the end of our session. And many were asking regarding the material link. Sir, material is of the source which was designed by me. So if anyone want the material, you can go to the description box. In description box, I have provided a number, mobile number, WhatsApp number to you. So anyone who requires material can send to the number, so that I shall provide the details, how the book is available and how it shall reach to you, where you need to purchase. Those are all details. I shall send it through WhatsApp. So you can go through the description box, a Google Drive link. There you can contact to the number, so that so how the material will be available will be given to you. Rather than that, we are telecasting it in the screen, so that it was easily visible to you. You watch the video in 360p, so that you might be aware of it. Okay. So I think today's discussion is very, very useful to all the students, CA members in practice. And we have designed it in a user-friendly manner. And we are also going to present all the important topics which were useful for exam and also for CAs in practice. And we are also going to specify assessment procedures also at the end of our discussion. Scrutiny assessment, best judgment assessment. All these were very useful for all the members in practice and also for CA examination students, CA final exams. First 7 sessions, first 6 sessions may be useful for CA IPCC also. And coming to all the sessions, entire 15 sessions shall be useful for CA final and practicing CAs. But for IPCC, first 6 categories and discussion on math, those elements were only be useful. So based on that, you know the applicability of your syllabus. So you watch the video based on your preferences, based on your applicability. But we are going to discuss from all India point of view, everyone to reach the basic concepts and all these provisions, theoretical aspects. We are going to have a discussion in a simple, very useful, our English language, easy language. We are going to discuss it, so that everyone might be aware all of these topics. It's a very, very knowledgeable session. So subscribe to this channel, so that everyone might get awareness regarding future programs also. So here we have a doubt. After concluding this, we will conclude our session. Sir, how dollar rate is controlled if gift is given? Okay, I mean calculated, I think so. Dollar rate, actually we are going to prefer SBI rate, the SBI rate, Income Tax Act always refers to the SBI rate which was notified by them. So based on that, we are going to convert it and it shall be taxable in India. Okay. So I think the doubt is very clear. So by this, we are going to conclude our today's session, and tomorrow we are going to begin our discussion at 10 a.m. So every day we are going to begin at 10 a.m. 10 to 12, actually it may not be end by 12, based on 15 to 20 minutes we are going to take an additional time, so that the topic will be discussed in a complete manner without raising of any query. Okay. By this we are going to conclude our today's discussion. So subscribe to this channel and you will get continuous updates regarding this taxation. So thank you very much.